Good morning, good afternoon, and good evening, everybody. Thank you very much for joining us. We will give people a few seconds to settle in before we kick things off. I hope everyone is ready for what we expect will be a very informative and hopefully exciting discussion. My name is Dan Osuski, and I am the Chief Research Officer at the International Foundation for Valuing Impacts. I'm incredibly honored to be here amongst colleagues across the Value Balancing Alliance and IFVI on our technical staff to share with you the work that we've collectively been doing on the topics of adequate wages and greenhouse gas emissions. I will give us a few contextual opening remarks to provide some background for this work before handing it over to our colleagues to do a bit of a deep dive on the two topics that we currently have released for public comment and are really excited and inviting your feedback on the work that we've been doing as we carry it forward. And so that will begin with the topic of greenhouse gas emissions, and then we'll talk about the topic of adequate wages before wrapping things up for closing remarks. And so to start us off with a bit of background, it was the beginning of 2023, so just over a year ago, when the International Foundation for Valuing Impacts and the Value Balancing Alliance announced a partnership to collectively develop a globally applicable impact accounting methodology that is available and serving the public good, and so it's accessible to everyone. Our collective mission is to build and scale the practice of impact accounting, ultimately with a goal of promoting corporate decision-making that is based on risk, return, and the impact of an entity on their stakeholders. We are, as mentioned, incredibly pleased to have released our first topic methodologies as a part of this impact accounting overall methodology on adequate wages and greenhouse gas emissions just a few weeks ago. And we are inviting public comment until April 8th of this year. And so we hope that this conversation will provide you some valuable context about what has gone into the methodology to date and give you a preview of some of the particular questions that we're really curious to hear your feedback on as stakeholders as we continue to improve this work. First of all, what is impact accounting? For those who might not be aware, ultimately, impact accounting is a system for measuring and valuing the impacts of entities to generate impact information that can actually inform decisions across an organization's sustainability performance. The aim is, in a lot of ways, to bring the rigor and principles of financial accounting, as well as the scale of it, which is a norm in the marketplace, to the concept of impact. And in particular, the work that we are collectively doing within impact accounting is translating environmental and social impacts into the language of currency to allow for that type of decision making really at a very practical scale. And so our vision is for impact accounting to generate information that is ultimately as foundational to corporate investor decision making as the information that is traditionally generated through financial accounting. The work that we're doing in the spirit of the public good has a number of robust mechanisms in place to ensure that we are serving that public good. And that begins with the processes that we undertake to develop the methodologies and the governance that sits over top of it. And so the partnership has built these formal mechanisms to ensure that we are inclusive and transparent and really opening the work that is being done to the feedback of you all, the public, and our stakeholders and the stakeholders of businesses. And so there is an independent governance body that is called the VTPC, the Valuation Technical and Practitioner Committee, that ultimately oversees the governance and the decisions that go into the methodologies. And then there is a due process protocol that's been established that takes the work that's being done on the methodology through a variety of phases to ensure that that work is as credible and as of high quality as possible. Including in that due process protocol is a public comment period, which is where we are right now. And so we are really pleased as a part of this work to have developed a first draft with the support and oversight of the VTPC. We are now presenting this to the public for public comment for us to be able to get further feedback to continue to improve it over time. We have also just released a few weeks ago the first official statement of our methodology. That is General Methodology 1, the conceptual framework for impact accounting. This body of work underwent a public comment period in the fall of last year. It received final approval, a revised version based off of that public comment at the end of 2023 and was just released on February 22nd. This methodology statement is intended to apply to the work that will come after, including the topical methodologies that we are sharing right now, and is intended to establish the foundational principles and concepts that will be a through line throughout the work moving forward. Topical methodologies, like the ones that we are presented now, are intended to then provide specific guidance on the measurement and valuation of impacts at a sustainability topic level. We are developing these aspects of the impact accounting methodology on a rolling basis, beginning with the two topics that we're presenting today, greenhouse gas emissions and adequate wages. There is a consistent framework within the statements that you will see when you go through these public exposure drafts, beginning with an explanatory note that provides context for the draft itself and discussion questions, followed by an executive summary, then an introduction and articulation of the impact pathway of the particular topic, how that impact pathway translates into impact driver measurements from an organization, to then how it goes through a measurement of the outcomes, impacts, and valuation, with an acknowledgement of areas for potential future development of the topic methodology moving forward. And so I'm going to hand it over to our topical experts to give you a deep dive into the specific methodologies that we are presenting today. And I would encourage everyone, as those individuals present, to share your questions in the question function of this webinar, so that way when we move to a Q&A opportunity, we will be able to curate and respond to those questions in an orderly fashion. And so with that, I'm pleased to hand it over to my colleague at the Value Balancing Alliance, Dr. Michael Verbucco.
Thank you, Dan. Hello, everyone, also from my side. Happy to introduce a bit more on the greenhouse gas emissions methodology, which you can see here. And I would start to give a little bit of an overview of the purpose of this particular part of our impact accounting methodology. So the GHG emissions methodology is really establishing causal linkages between GHG emissions and outcomes and impacts which affect people's well-being. So meaning that by measuring not only the GHG emissions, but also then translating that into a monetary figure, we really then assess how people's well-being is affected through also changes in the environment. And this information then really is used to improve decision-making by different stakeholders, whether it's the managers of the entities, whether it's external stakeholders like investors or other affected stakeholders, to really better understand the contribution or harm to sustainability of an entity. So what are the key proposals in this exposure draft? And this is, of course, subject to change, especially now that we're seeing here the exposure draft. We're relying on your public comments, but the key proposals in this exposure draft are the following. First of all, we develop an impact pathway for the greenhouse gas emissions of a company. We also include scope 1, 2, and 3 emissions, so aligning with the GHG Protocol, and also align the impact driver measurements with the reporting requirements that we can see in current sustainability reporting. And we built on the two state-of-the-art social cost of carbon models, which are the so-called GIF and DSCIM model, to really then derive a globally applicable value factor. And it is a dynamic approach to like social cost of carbon modeling, so it will have like changes over time. Going to the foundation of it, where do we build our methodology on? So we have like three main areas, and the listed or like displayed publications are just like a snapshot of like the actual extent of the review that like lies behind this. Is like on the one hand the sustainability related disclosure frameworks and standards that we can see on an international level, whether it's like the European sustainability reporting standards, the international standards from the Global Reporting Initiative and others, like also from the IFRS ISSB. But also climate change research builds the foundation here, as well as like building on important work that has been done in the impact management ecosystem. I mentioned the social cost of carbon, and to like put that a little bit into perspective. So here we're talking about like a net present value of like the aggregated climate change damages. So by 1 ton of CO2 emissions, basically what kind of like aggregated damage can we assign to this kind of like emissions then? And there are different social cost of carbon models, which are incorporated in various forms, and also like they actually like then have different impacts. They include time periods, they include, and also future assumptions. But you can also see that there's like, especially now by more and more jurisdictions, governments, policymakers, and companies, specific social cost of carbon models which are more and more incorporated. So it's like frequently used, but especially the state-of-the-art models which are listed here, the GIF and the DSCIM, those are like more and more used also really like to assess the damages from carbon emissions. How did we come to this kind of methodology draft that you can, the exposure draft that you can see here? We have like an initial research phase where like really like a lot of reviewing of existing approaches, of like existing materials, and also the standard setting environment has been considered. We had like a lot of experts consultations that come with that. And then as Dennis Huska already mentioned, the VTPC, the independent body that oversees our methodology, was then coming together in smaller groups to really go into the details of the methodology and to further improve some of the initial drafting. And then after several discussions, also then the final approval for the exposure. So now we're ending with the, well, not ending, but like now the public commenting period and also piloting actually are happening right now. So we're not only want to like understand whether the methodology is like from like some of the conceptual elements sound, but also whether it's like practically feasible. So like it works in combination. And just to very high level quickly go through the main content. So we have in the introduction some key definitions and concepts defined in the scope, going then into like more details on the impact pathway, including really like the data requirements, also data sources, and like how you address gaps, and then going into the valuation of the impacts with additional information then of course also on specific parts of the methodology, whether it's like details on social cost of carbon, etc. And just like to clarify the scope of the methodology again, we're including similarly to the GHG protocol, really the scope 1, 2, and 3 emissions, which is also in line with all the standards that we can see on sustainability disclosure. And important here to highlight is that we're not taking like one specific stakeholder group into account for the GHG emissions methodology, since society as a whole is affected by climate change, by the consequences of GHG emissions. So therefore, like a whole societal perspective is used to then determine the damages. And also important to know, we do not yet have included the avoided emissions or like also carbon offsetting. This might be then also one of the areas for future research, but would be out of scope for this methodology as it is like proposed in the exposure draft. And with that, handing over to Carter.
Yeah, thank you, Michael. So we're going to now transition a little bit and tell you a little bit more about some of the details of what data you might need or how you might actually apply the methodology itself. And so the next section lays out this impact pathway, and this impact pathway really defines this set of processes from inputs and outputs of an organization or an entity, and links that causally, as Michael mentioned previously, through to the outcomes and the impacts themselves. In this section, we also acknowledge, and you'll hear more about this a little bit later, that the current work that you're seeing likely results in an understatement of the negative impacts on society, mostly because present research has not fully been able to capture all the impacts that we sort of know to exist. With that said, you'll hear a little bit more about that whenever we talk about the valuation and the value factor. So on this next slide, you're seeing the actual visual of the impact pathway itself. This will be a theme throughout topic methodologies. You'll see one later for adequate wages, for example. And what we're, again, doing here is linking these outputs, greenhouse gases, across all scopes, to changes to the environment, things that many of us are well in tune with, such as rising temperatures and changing precipitation, sea level rise, et cetera. And we're then linking those to impacts on society in monetary terms. And so you see a variety of things there. And the social cost of carbon is really allowing us to make this linkage. This is sort of a well-established framework, as Michael's mentioned previously, that's linking each ton of emission, each greenhouse gas, to these outcomes and impacts. Ooh. So now we get to section 3, which is about impact driver measurements. And really what this is what are the data needs that somebody would need to apply this methodology, along with some additional perspective or guidance around data gaps or data estimation, for example. So as Michael mentioned previously, this section clearly lays out full scope 1, 2, and 3 emissions, that all of these emissions need to be converted to CO2 equivalents in metric tons, sort of, again, in alignment with other reporting standards that entities are likely or may already be using. There's a significant section that guides users through data estimation and filling data gaps. And the document acknowledges that this is sort of an important area where the data estimation or the data needs and requirements are sort of developing, but many entities may not have sort of full scope 1, 2, and 3 emissions. And so we provide a lot of guidance there, or some general guidance about how that might work. But really what we do throughout this section is the methodology leans heavily into the greenhouse gas protocol. So if an entity is already using the greenhouse gas protocol for calculating their emissions or needs guidance, the document in several different places sort of points to those series of documents from them on how the data requirements might be produced. The last thing that this section does is demonstrates rather clearly how these requirements align with other reporting requirements, as Michael mentioned previously. And so on the next slide, you can see that we've sort of provided this in 2 ways. We've provided it, one, with sort of a descriptive text, section 3.2, but then we've also provided this table that's been copied into this slide that shows which paragraph in each of these different reporting standards that describes the data requirements that this document's asking for. So again, there's no expectation that additional data is needed to use this methodology if entities are already reporting to some of these other reporting standards. So finally, we come to the outcome, impacts, and valuation section. And this is really the section of how do you do the math, basically, and how did we get to the approach to do this work? And so it basically provides a set of formulas, valuation formulas, and a value factor to be used. And so in the middle box here, you see a series of equations. And really all these are taking emissions in those GHG CO2 equivalents and multiplying them times a value factor. Now, the methodology states that valuation should be conducted and presented separately in 4 categories: Scope 1, Scope 2, Scope 3 upstream, and Scope 3 downstream. This is to enhance clarity, to enhance comparability, and decision usefulness. But on top of that, to get your sort of total greenhouse gas emissions impact, you can sum those 4 values into a single equation, or into a single value as well. And there's some example calculations doing this work in one of the appendices if anyone sort of needs some guidance there. Finally, the other thing that this section lays out are these value factors using these 2 models that Michael has mentioned previously. And if you go to the next slide, Dan. I want to talk a little bit more about these 2 models given DSEM. So Michael mentioned earlier that these are sort of new models, but I wanted to go into a little further detail of why we chose them in addition to just the fact that they're new. And so one is, compared to those predecessors, they're built on more data that represents more countries on the planet, longer time periods of analyses. They model impacts on society of the emissions that occur today all the way to the year 2300. They analyze impacts at either the national scale for GIV or even subnationally for DSEM, allowing for a greater precision of analysis. They also, compared to some of their predecessors, have some adaptation functions, or this idea that society responds to extreme events, basically, and that there's some adaptation involved. They incorporate uncertainty throughout components of the model. And finally, they're actively updating, which is one of these reasons that will allow us to continue to update them into the future. The last point is that both models were run using a dynamic discount rate, so using the Ramsey formula for those that are familiar, and it's calibrated to meet a near-term discount rate of 2%. And so now we get to the value factor itself. So the value factor to be used for 2023 emissions is $236 per metric ton of CO2 equivalent. That number goes up slightly for 2024 emissions, and that's because of reduced discounting as you get into the future. But the other thing the methodology clearly or proposes to lay out in this exposure draft is that there are several reasons that this value will need to be updated over time. First and foremost is just an adjustment for inflation year over year so that the financial impact accounting data from this is comparable to financials in that same reporting year. There's also this, I mentioned previously, that the damage functions or the calculation of these impacts on society are constantly being updated. There's a lot of expansion in that space. And so as those are updated, the value factor itself may be updated. As we progress through the years, point 3 is that reduced discounting of damages will occur as we get closer to the days that those are occurring. And then finally, general advancements to these model frameworks that might align with some of our principles is sort of the last reason that this might be updated. So now in the last part, I'm going to pull out, well, let me just quickly talk about future development. Sorry. I'm not going to go through this in detail, but just to say that we also acknowledge that these methodologies will be sort of present opportunities for advancement of this work over time, and we highlight some of those ideas within this section. So now at the last part, there's several questions in the explanatory note that guide you through some of the things that we're thinking about for feedback, including a general question about overall comments, but I want to pull out two in particular. And one is this value factor methodology based off this social cost of carbon. So on the right, I have in the green box the specific questions that are asked in the explanatory note. And on the left is a little bit of context, but I just want to go through these questions. One is just generally, do you agree with the approach taken in this social cost of carbon within this methodology, including this idea that we take these two best available models and average them? The second is this idea of the 2% dynamic discount rate that estimates damages to the year 2300. These are sort of decisions that have to be made. And is the reasoning for how we presented this clear enough, and why or why not? And then finally is this point I've made that the value factor will get updated over time, and is the description of that dynamic price that changes over time clearly presented? The other question I wanted to pull out as an example is about the usability of the methodology itself. And so there's sort of two questions on question 3 that ask about general framing and the logical structures. So Dan mentioned all of these topic methodologies will follow sort of a similar structure, or at least a proposed structure. And we're asking for feedback on, does that make sense? And is it written in a way that's clear? And how would you enhance the framing if not? And then finally, this section 4 about outcomes, impacts, and valuation is all about how you use the methodology. And so we really want this section to be clear. And so we're asking a question about the extent to which this guidance is clear as well. There's a couple other questions, but I'm going to stop there. And with that, I'm going to pass it back to Dan for a little bit of time for Q&A. Thank you.
Thank you, Carter and Michael, and thank you everybody for sharing some questions that are already in the chat and in the Q&A function. We will go through the ones that have already been written. I will probably do them in some slightly different order. But I think we will be able to get to each of them. And if you do have further questions, please continue to share them in the Q&A function. I will begin first just noting that there is a few questions a little bit more on the logistical end. We will be sharing these slides to registrants to the webinar following this meeting. This recording will also be made available on video channels, so this can be watched again. We would expect these to have the release of those to happen sometime by the end of next week, but that is TBD, just based off of the technical questions there. To move to the aspects of the methodology, I'd love to begin with a question from Carlotta about the risk of double counting when including Scope 3 emissions.
Yeah, happy to take that one. So there is, of course, double counting whenever you have like Scope 3 emissions with regards to like the emissions that like another organization in your value chain has like already like counted for as like Scope 1 emissions. That is the part of double counting which we see as like necessary, especially when you want to have like decision useful information, because you need to be aware of like your emissions in your value chain in order to make adjustments, in order to like better understand that part. Important for us is that we do not have double counting within our impacts that we account for across like different topics. So double counting across the value chain is like something that is unavoidable just by the nature of like Scope 3. But that's really like also where you need that information in order to then really like have steering useful information. Maybe Carter, I don't know whether.
Carter, anything else to add?
No, I think Michael summed it up well.
Great. We've got a question from Laura, specifically relating to the role of the GHG protocol in in the methodology. Could you speak a little bit to how we build off of that protocol?
Yeah, definitely. Particularly around the data requirement side of things for our methodology, the methodology is not intending to sort of recreate sort of the foundational work that's been done both by GHG Protocol, but also by other standard setters. And so in general, we provide some guidance, but made sure that our approach and our messaging in the methodology aligns with that. And it leans heavily on the GHG Protocol, particularly in the section that's talking about data gaps and estimation as well. A lot of that text is pulled from ideas that come out of the GHG Scope 3 guidance document specifically. And there's even a clause in there that sort of says if there's something that's not clear, that really for data requirements, meaning the data needed to run this, that the GHG protocol is where this methodology is pointing to that as sort of the best place to go for that information.
Thank you, Carter. Michael, anything else that you'd add on that?
Maybe just highlighting that, of course, the GHG protocol is also what informs all the sustainability reporting. So it's something that makes us also ensures that all the things we include in the methodology are informed by the reporting requirements as well. So that's one of the key aspects also why it's so important to build the link to the GHG protocol.
Thank you. We have a few questions around the specific aspect of the carbon price, but before we do that, I do want to raise one question from Camilla regarding the role of offsets. This question says, I understand that reducing emissions is the main driver for minimizing monetary damages of a company's corporate impact. If internal measures, such as internal pricing, are implemented to contribute to emission reduction, should these be accounted for? Or does this consideration apply solely from a double materiality perspective?
Sorry, I hadn't read this question yet, so I'm just thinking, but happy to respond.
And Camilla, it might be helpful if you've got some further clarifications on this. We can potentially try to provide an initial response, but you might have some other thoughts as well.
Yeah, let me just start with the sort of, in that one slide, we've lumped in the idea that, credits, but also other offsets, as well as renewable energy credits and avoided emissions, we sort of lumped them all in together as not included within the scope. And probably the biggest purpose of that was to clearly define the boundaries of this methodology around emissions themselves. So sort of tackling emissions first. We fully acknowledge that all of those mechanisms are important for the broader conversation and the broader context of sort of getting us to some future state where emissions are reduced and we can offset some of that as well. So there's an opportunity to enhance that work in the future. As far as other internal measures such as internal pricing, those aren't explicitly accounted for within this document. This document is really taking those steps of linkages to calculate the impacts on society of each ton of CO2 equivalent that is emitted. But again, I would acknowledge that all of those sort of internal pricing strategies or mechanisms or offsets are incredibly important tools for companies to consider how they go about their strategies for sort of reducing emissions in and of themselves and or offsetting those emissions in other ways as well.
Thank you, Carter. I think there's a related question here that we can build off of, and Camilla, if there's any other clarifications you can offer, please feel free to do so as well. Before moving to this other question, I also want to acknowledge the second part of that question around double materiality, and also just clarify that in terms of what is being calculated from a monetary perspective in this methodology, it is the impact from a monetary perspective on society. It is not the impact on an organization's financial performance, and so that is already on the societal side of a conception of double materiality. We do have a question from James that asks, would you imagine this replacing an organization's internal carbon pricing?
Maybe
Michael, do you want to take that one? Yeah.
Yeah. So there's not one answer to that probably, because there's different usage of internal carbon pricing in organizations, and they follow different purposes. So I would not say that per se you just immediately completely ignore any of these other purposes where you might want to then look at, so what kind of abatement costs do I have, like, in order to like reach a certain emission goal, or these kind of like questions require are different than like the question of like, so how is society affected by 1 ton of CO2 emissions? And that's what we want to like understand here, is like really like how is society affected by this additional ton of CO2 emissions? So depending on like what your decision case is, or like the question that you ask for, like this internal carbon price, you might want to also have like other mechanisms in place. But Carter, if you have like additional thoughts on that one.
I agree with all of that. Yeah, that it's not a simple answer. What I would say is, if the intention of your carbon price is to understand the impacts on society of each ton of emission that occurs, GHG emission that occurs, then this methodology is sort of, we would argue, is using sort of the best state-of-the-art approach and understanding of that value as well. So if that were your purpose, then this could replace it. But I completely agree, there's many other mechanisms and purposes for why internal carbon prices may be used.
Thank you both. And we do have a clarification from Camilla that I think is still related to this conversation. The question is, if a company has established private costs when trying to implement reduction strategies, so if they do have an internal price that they are using, should that be discounted from the monetary impact in the methodology that's been produced here?
Again, I don't know that there's a clear answer for this, but I'm happy to take it first. Again, it would depend a little bit on what that private cost is, but again, what the methodology is trying to do is sort of say the impacts on society of each ton of CO2 is this amount of dollars, is $236. And so if it doesn't really affect, it's not linked to any other strategies that happen within a company, it could be used to frame this information against, or not against, but frame this information with some private costs or some other internal purposes that are occurring within an organization. But I don't know that I would say that it should be explicitly discounted without sort of knowing the use case.
And I think in particular, it is important to emphasize that in the scope of this methodology, offsets and other things related to offsets are excluded. So this is intended to be a direct measure of the emissions produced of an organization. And so any other strategy in addition to that would actually fall outside of the scope and would not be discounted within this methodology. There is the possibility for us in the future to develop a companion methodology that would capture the potential impacts in either direction, positive or negative, of things like offset purchases, but that would not be a component of this particular methodology. We've got one practical question from James, and then I'm going to move us to a few questions that are asking about the decision around the discount rate and the choice behind the valuation factors. The practical question is from well, I see two now actually. They're both from different Jameses. Practically speaking, if a ton of carbon-2 equivalent is $239, and you had a product level impact of, say, 14 kilograms of CO2 equivalent for a single pair of shoes, could we then assume that the estimate for the cost of the carbon to that pair of shoes would be basically 0.014 times 239, and therefore about $3.35 for the carbon impact of that single pair of shoes?
Yes, I think that's a great example of a specific use case where you would know a product related impact that you've calculated the data requirements for in CO2es, and then you're using this methodology to apply it to that product and to understand the impact.
Great, thank you. There's another question from James. Will you be listing the data points for the reporting impact? James, if you wouldn't mind, it might be useful to get a little bit more clarification on what you're referring to there, and we'll go to some of the other questions if you'd like to share that in. But we've got two questions around the price, the inputs into the price itself. The first is if you all could just elaborate a little bit more on how you decided on the model behind the valuation factor. So why GIVE and DSCIM versus others?
I'm happy to take that unless you want to, Michael.
Go ahead.
Yeah, definitely. So a little bit more context. First of all, the social cost of carbon work takes an impact approach, which is why we've used that framework, this social cost of carbon framework, to set the cost of each ton of CO2. Within that framework, there have been social cost of carbon models around for decades. And Michael highlighted a few examples of the predecessors that were sort of built in the aughts and early 10s that have been used. Really what happened throughout the mid-2010s, though, is that there was this significant push for a big update and sort of a coalescence and an ease of use of these models. And what that resulted in was basically these two 2022 models developed by collaborations of many researchers to produce these two updated models that were sort of a response to that push for updates. And these include people who had built the predecessor models. And so what that resulted in is some of the highlights I mentioned on that one slide. The inputs include data inputs to build the models from more countries, including sort of an economically distributed set of countries across the globe. The impacts are modeled with a different set of rigor, basically, in many cases. There's these adaptation features built in. Instead of modeling only to 2100, we now have the technology to model to 2300, for example. And so really the decision making in the model was built around the fact that these two models were the clear state-of-the-art version that's being taken up. And because they're relatively new, maybe people don't know about them as much, but they're sort of building quickly within the landscape. And so at the same time that we were doing this, it was clear that they were sort of much advanced and for myriad of these reasons than their predecessors.
Yeah, also the granularity on like the how damages can be like now like better understood in these models is like just way higher. And as I also have shown, like the expert consultations that we had, so like of course there were like a lot of those also coming from either like governmental organizations and others that are like also like widely applying social cost of carbons, like were like also directing us like in the same way to those updated models. So like there's like very good reasons on the one hand, really from like a technical point of view, but also from like the uptake in the market already like indicates that it's not just our judgment that's like really like says like, okay, we should go for these models, but it should be like it's like widely accepted basically.
Thank you both so much. There's a few more questions coming in related to the underlying models for the cost of carbon. We have a series of questions from Akali that I think builds off of some of the things that's already been shared. So if there's anything that you'd like to elaborate on. The questions are, on what basis is it possible to extrapolate to 2300? Is there such a rich history of data to actually make that meaningful? I will list out a few of these questions for you all to respond to. What are the underlying assumptions to forecast up to 2300? And a sub-question of that is it incorporating targets towards net zero, and that this could ultimately slow down damages? And so that's how are they predicting what might be changes in trajectory over that 2300 time frame. And then related to that, is there a term structure of the value factor, or is it taken to be constant across all those future projections?
What was the last question? I was just writing them down.
Is there a term structure to the value factor, or is it taken to be constant for the future projections?
Yeah, I can answer a couple of those. Yeah, it feels like it should be hard to predict the future all the way to 2300. But the way that even these types of models would do this to 2100 for that matter, much less 2300, is there is a sort of choice or an assumption that has to be made of what we think the trajectory of emissions will be over that time period. And so if you're familiar with the IPCC work, right, this is what RCP pathway, represented concentration pathway, is ultimately followed. The one that's within this is basically emissions peak or start to go down before 2050. But it's a fairly gradual, and it would be described as sort of a median approach to that. The relationship with that and population growth through 2300 is really linked to sort of our expectations of growth rates, economic growth rates into the future. And so over long periods of time, such as through 2300, those are relatively stable, right? There might be years where there's 7 or 8% growth and years where there's very little growth based on sort of extreme perturbations like COVID, for example. But generally over that time period, that growth is relatively stable. And so the linkages between growth and population and climate trajectory are linked, and there is a decision in the front end of the model made to that. But I would argue that those are all sort of median perspective proposals. Targets towards net zero. So yeah, this is a good question. If society, if that climate GHG emissions pathway doesn't follow the model in and of itself, then that can easily be modified into the future. And what I mean by that is if we actually successfully, if we were to dramatically change trajectory and by 2040 the globe is carbon neutral, or 2050 the globe is carbon neutral, then over time the models would update that and the cost of carbon we would put out would be much different. The cost of each marginal ton of carbon at that point would in theory be smaller. And so that would be related to responses to net zero potentially. But in the moment, it doesn't sort of explicitly take into account targets as like driving us to some net zero change. It's sort of taking the assumption that the median understanding of the trajectory you're headed on is the most likely trajectory. And what was the last question related to that, Dan? I'm sorry.
How does the term structure, does it vary over time?
Yeah. I can't speak with any specificity, but yeah, the model is basically run at each year, including in a different input based on model predictions of some of those things I just described, like growth rate and GDP and population changes and things like that. It's also then the discounting would ultimately result in the damages as you get further into the future sort of being less. And so on the one hand, the question around 2300 sort of gets to this idea of like, how do we do it that far in the future? But we also would acknowledge that the model is discounted at a rate that ultimately those impacts that happen in 2300 are quite like minuscule values on that total value of impact relative to the ones that happen in, say, the year 2030, 2040, 2050. Michael, do you have anything to add? It's a lot of technical questions, but yeah, good questions.
Yes, but I think that you really explained that well. It's hard to add anything at this point in time. I think that would be like really then go into like the very details.
Great. So we are not going to have time to answer all questions. I'm noticing a few practical questions around how this relates to the balance sheet and potential data usage moving forward. what I will suggest is for anyone who has questions that are unanswered, you are welcome to follow up with us after this session. I will, however, pose one final question that's still focused on the methodology itself for this group to respond to before handing it over to Tamsin and Fran to talk about our adequate wages methodology. The question is from Kiara, and it's, how did you decide which impact pathways to prioritize, given that an additional ton of carbon dioxide can have countless consequences both on the environment and society? And would you suggest to adjust this proxy nationally, depending on the cumulative contribution that the different countries had to the accumulation of carbon into the atmosphere, to highlight the difference between developed and developing countries?
I love it. That's a lot of layers in that question. It's a great question. Maybe starting with like adjustments. So in general, like what we are now seeing is like, because carbon doesn't really like, and we're taking the perspective of like an entity, not necessarily like a country in this case, where these emissions are coming from. So therefore, the climate change from like one additional ton of CO2 is not really like stopping at the border, but it is a global phenomenon. So therefore, like adjustments on like a local local condition, which for GHG in particular would really make it very difficult, because it's not necessarily related to, like the changes at least, or like the impacts do not materialize close to the emission source. As you well pointed out, like developing countries might have not like emitted quite some of those, but are like often hit quite hard by the consequences of climate change. And so if we would have like that combined with emissions, with like the location of the emission, that would maybe misrepresent also like the impact that we have on society in this case. To like answer that part already, maybe for the other, like I hand over to you, Carter.
Yeah, and I would just second that the social cost of carbon doesn't weight things based on past emissions. I mean, I can understand the logic behind that, but it's just saying for each emission emitted today, what are the effects from now until 2300? And so you could take the value though and sort of apply it to the past at a country or a government. That's not our or a business, but that's not our primary use case here, right? But it would apply in theory there. As far as the decision of impact pathways, these models are sort of highly advanced compared to the technical sort of expertise that our organization has. And so if I'm being frank, we really are leaning into the consortium of dozens and dozens and dozens of people doing this work and developing rigor within that. I mean, we did evaluate them each individually. And with that said, there's a lot of other impacts on the horizon. Because we're not the primary developers of those models, we can't say with any certainty, but through direct conversations, I can say that there's a lot of updates that you'll see in the coming years to both models that sort of are doing a better job of modeling impacts on other aspects of society.
Wonderful. Thank you both. I'm going
One more
to
thing, Dan. I'm happy. Sorry, Dan. I'm happy to try and answer a few other questions just in the chat as well, if that's helpful for people while Tamsin and Fran talk about wages. Okay.
Yeah. And so I do want to remind everyone before transitioning over to the adequate wages, these are exposure drafts. And so a number of these questions that are being raised will hopefully inform the opportunities that you have to provide feedback on the methodology and how it can continue to be improved. And so we are inviting all of you to provide your commentary during the public comment period. And I always say that no matter how much you feel you are an expert, there is value in your input into this work, because we are seeking a wide range of inputs and ultimately want this to be as practical and useful as possible. And so we've, as Carter has mentioned, we've included a number of targeted questions in the exposure draft that we are particularly interested in. But we are open to any type of feedback that can be provided. We do have some instructions in the explanatory note that you can see here as well about how we'd like to be able to receive that input. We have an email address included here that is research@ifvi.org, is where you can both submit your comment letters, but also if there are any follow-on questions or interest that you have in this work, you can reach out to that email inbox and we will be responsive to that. And so thank you, Michael and Carter. Welcome you to continue to answer some questions in the function. I will hand it over to Tamsin and Fran, but actually before I do that, I have one request for our audience, which is if you could please leave your questions in the Q&A functionality within the webinar, and so that way everyone can see them in a consistent location. Thank you very much, and I will hand it over to Tamsin to talk about adequate wages.
Thank you, Dan. So before I dive into the details of the methodology, I wanted to provide a little bit of color on why we decided to develop an adequate wages methodology. Why is it important? And I want to underscore that, and just maybe resting on the previous title slide, this is a really widely applicable topic to all entities with workers, and wages can have significant impacts on well-being. So wages provide an income to workers. That income supports their well-being. At the same time, there's also a high global toll on workers earning below the living wage. So as of 2020, over 1 billion working people worldwide were earning wages that were inadequate to support a decent standard of living. And so, with that as context, we wanted to dive in and develop a topic methodology exposure draft. So the adequate wages exposure draft followed the same methodology development process as for greenhouse gases. I won't, explain every stage because it was explained well with the previous session. We are now at the final stage in this diagram, which is public commenting and piloting with VBA member companies. And I do want to highlight a few inputs to our thinking that were really, really critical that are mentioned here on this slide. First, a huge reference point for us was existing wage-related impact accounting methodologies, including earlier work by the Impact Weighted Accounts Initiative and VBA, SHIFT, Capitals Coalition, Valuing Impact, and the OECD. We also made close reference to disclosure standards, especially ESRS S1 on workforce. And we researched the best available literature on the link between wages and well-being, largely from the economics and public health literatures. And finally, but not least, we looked at living wage benchmarks around the world, which is a sort of area of research that has really grown. And so with that as our process, I'm happy to give you a first look at the methodology. So taking a step back, the impact accounting system as a whole is really composed of multiple methodological statements, each with their own scope. And so this particular topic methodology focuses on wages. There are certainly other work conditions that are hugely important to the well-being of workers. We can think about job security, working hours, occupational health and safety, which is actually on the current work plan. These are subject to future development. It was also decided that the topic methodology cover both workers in an entity's own workforce and value chain workers. And this is really acknowledging that value chain workers share the same rights to a decent standard of living. And it's also following momentum from civil society and other standards to really start considering value chain workers. So onto our impact pathway for adequate wages. We start here with labor, provided by workers as an input to business activity. And the activity of the impact pathway is the act of paying workers' wages. That activity results in two outputs, which we've parsed here in two different bubbles. The first is remuneration, which refers to wages paid to workers of any amount. And that output enhances workers' well-being, measured here in this topic methodology as subjective well-being, by allowing workers to consume, save, and otherwise fulfill their needs and wants with income. And that second bubble, the second output, is living wage deficit. So here we're talking about for wages below the local living wage benchmark, right? The amount that is needed to live a decent standard of living for yourself and your family. We're looking at the amount by which wages fall below that benchmark, which we call the living wage deficit. And so wages below the living wage benchmark are conceptualized as eroding workers' well-being through material deprivation, psychosocial stressors, behavioral stressors associated with deprivation. And a quick note, diagrammatically, we've kept remuneration impact and living wage deficit impact as separate sort of lines here intentionally to reflect that the two are not to be added together. And I'll add a little more rationale for that as we go on. So here's an alternative visualization of the impact pathway. It gives you a little more insight into how we're disaggregating categories of workers A, B, C, and D. So for workers in category A, they're earning below the living wage. And these workers are experiencing both some remuneration impact associated with that wage and also a negative living wage deficit impact. Workers in categories B, C, and D are all earning above the living wage. And so these workers are not personally experiencing a living wage deficit impact, only the remuneration impact. And it's worth noting that, the disaggregation between B, C, and D, each category is earning more than the previous category, with D earning being the highest earners here. And that disaggregation is what helps us incorporate a simplified notion of the diminishing marginal utility of income with inflection points between B and C and D, which Francisco will talk about a little bit more later. But for really detailed information, definitely point you to the methodology and its appendices. And so I do want to highlight our decision to include remuneration impact within the scope of this topic methodology, because there are other approaches that don't or treat it differently. And so the Impact Weighted Accounts Initiative previous methodology, for example, did include it. The work by Shift and Capitals Coalition has focused only on living wage deficits. And then still others, like the previous VBA methodology, have conceptualized remuneration as part of a separate gross value added methodology in terms of an entity's contribution to GDP. And so how did we arrive at this decision? And really, there are three factors that are key to consider. And the first is quite fundamental. It's alignment with the impact accounting system's emphasis on measuring absolute impact. So General Methodology 1, which is excerpted here on the right, describes absolute impact as the difference between the outcome stage of an impact pathway and a default reference scenario, which is a scenario where an entity's activities and comparable substitutes are assumed not to exist. Marginal impact analysis is certainly important, right? This is adjusting for the actual counterfactual scenario of workers. But it was determined that we focus on absolute impact to provide really a consistent foundation that many entities can do in a similar fashion, and that other more sophisticated analysis like marginal impact analysis can be built upon. Second call out here is conceptual alignment with the economics and public health literature. And then finally, we value wage payments in this methodology in terms of their contribution to workers' well-being. rather than in terms of an entity's contribution to GDP. And so that's really intended to underscore the impact accounting system's stakeholder centricity and well-being focus. Final point of emphasis is that remuneration impact and living wage deficit impact are not to be added together per this methodology. And so an entity's living wage deficits should always be visible and not masked by aggregation. All right, so what data are needed to apply the methodology? As mentioned before, workers are disaggregated into categories A through D, and entities will need the number of workers in each of these categories and the average wage for each category. And the same data requirements are there for workers in the value chain. And so in developing these data requirements, we referenced ESRS S110, adequate wages, very closely. But we also expanded upon them, recognizing that there are naturally larger data needs for impact valuation in this case. And so knowing that the data requirements are more expansive, feasibility is definitely a big question that we have posed for public comment, and we're also exploring further with VBA's piloting. In addition to this data, entities will need data from other sources, including living wage benchmarks, as well as inflection points, which are provided by the methodology itself. And some information about living wage benchmarks, if we click for examples on the right. So we performed a review of what's the landscape of living wage benchmarks out there. And we're pleased to see that global consensus seems to be growing among those providers. And I'll mention WageMap Consortium as a development in that sector. That said, at this time, there are multiple benchmark providers to navigate, and each has, some are publicly available data sets, some are proprietary data sets, and they have different methodologies. And so given that kind of landscape, we have developed a set of required criteria that help entities navigate this landscape and achieve a level of comparability across benchmarks. We've optionally also provided some preferred criteria that reflect the latest innovations in the living wage sector, thinking about increased geographic granularity of benchmarks, inclusion of childcare costs in the cost of living, and so forth. And I'll introduce my colleague Fran to close us off with talking about measurement and valuation.
Thank you, Tamsin. Well, let's now talk about outcome measurement and valuation. And you can find a detailed description in the paper in the publication. So our aim today is to give you a first introduction so that you have some guidance. And so starting with the outcomes, we are focusing the analysis on the utility of income approach. This is the classic approach in economics to relate income and well-being. And we are building on the work by valuing impacts and the health utility of income that they developed, and also on the Accounting for a Living Wage project by Shift and Capital's coalition, in which they mentioned that living wage deficits should be multiplied by some type of utility of income. And in this approach, we are presenting a subjective well-being approach based on the recent developments that we've seen in the sphere, and mainly in the OECD. We see that they mentioned that subjective well-being is an effective measure to capture the combined effect of different life changes and circumstances in a living wage in a single measure. So this summative approach is something that we find very interesting for this methodology. And we have also been lucky to have access to the work of the World Happiness Report. They publish publicly data on income and subjective well-being, also on the effect of other variables. And we, with these two approaches, we have built the well-being utility of income approach, in which we have a way to translate wages to life satisfaction. And to evaluate those effects in life satisfaction, we use the well-by approach. developed by the Her Majesty Treasury and the Social Impacts Task Force. The worldwide approach gives you a tool to value 1 point change in life satisfaction on a 0 to 10 scale per person per year. So with this approach, we were able to quantify value factors. But how exactly? Then for that, in the next slide, we can see some of the details. Well, we have 2 components to calculate the value factor. We have first the well-being utility of income. The well-being utility of income that we just mentioned is equal to the effect of $1 change in income on subjective well-being. We have data for 156 countries, thanks to the work done by the World Happiness Report. And we can say that the interpretation is an approximation of the first derivative of the relationship between GDP per capita and subjective well-being. So in a simple term, we can say that the well-being utility of income is effective to reflect the sensitivity of well-being changes thanks to income in different countries. To value that, we use the well-by. The well-by chosen has been universal. We have one question in the public exposure to get your feedback on this approach, but what we have thought is that the value of a life satisfaction change is equal around the world, and it should value. We feel that in the end, life shouldn't be valued differently depending on the country that you're born. So these value factors are presented jointly and are publicly available in the methodology, and you can you can use it to monetize the living wage deficit and also to monetize wages. However, to monetize wages in the remuneration impact, we also have a diminishing utility factor, as Thompson was saying. We will see later on how it works, but the aim is to have also measures to control for within countries inequalities and not only for between countries inequalities. If you want to see some numbers, in next slide, you will be able to see how this relationship works. In the end, here in the horizontal axis, you have GDP per capita, and in the vertical axis, you have the value factors around the world. So the implications, which is what is really relevant for us, is that in countries with lower GDP per capita, the value factors are higher. So the sensitivity of income changes on well-being is higher in those countries. And we have the opposite situation when GDP per capita is higher. So in richer countries, the value factors are lower. And even in some countries, they are below 1, which means that not all the wages are translated into well-being, but in a discounted way. We also have the illustration of within countries inequalities. So as Thompson was saying, we are presenting a diminishing utility of income, marginal diminishing utility of income approach based on the literature. Here, our main challenge was to have both the empirical evidence and the practicality. So what happens in the real world is that curved line that you can see behind. And what we try to do is to approximate it with a piecewise linear function. It allows us to aggregate data. Otherwise, we should need to calculate the impacts employee by employee, and the process would be harder. So with this approach, we have both practicality and an empirical approach. And we have 3 segments. So in the first segment, wages multiplied by the value factors for workers category A and B. But those workers whose wage exceed the first inflection point are also discounted by this diminution multiplier. And when wages exceed the second inflation point, which is 4 times higher than the first inflation point, the well-being impact is limited to the effect on that second inflation point, and mainly because the diminishing marginal utility of income makes that well-being changes are hardly seen after that point. So this is the main focus of the methodology. As in the GHG methodology and as Carter presented, we also have a public comment period. We expect your feedback. However, we wanted to highlight some key questions that we think that they are especially interesting to have them here today. The first one is the idea of having both components. We have remuneration impact and living wage. They are not added together. Nevertheless, they are both presented in the same methodology. Why? Because we want to have a comprehensive approach, because we are focusing on the literature on poverty, but also because we are trying to focus on the workers' well-being rather than on GDP. So our idea is that not each dollar of wage is well-being as in the GDP approach, but we're trying to translate that to well-being with the well-being utility of income and with the well-beings. So our questions here are, if you agree with the inclusion of the remuneration impact, if you agree also with the articulation of the remuneration impact, and if you understood the default reference scenario that we included here, and why there is also a remuneration impact even in wages below a living wage. And if you agree with both the remuneration impact and the living wage impact being presented in the adequate wages methodology, even if they are not added together, or if they should instead be separated in separated methodologies. We have, and a second question we would like to bring here today, which is about the subjective well-being approach and the well-being utility of income. As you know, this is one of the additions that this methodology presents, and we would like to know your feedback. If you agree with the subjective well-being as a measure, if you agree with the well-being utility approach and how we presented it, and if also you agree with having the World Happiness Report as a basis for our well-being utility of income factors. And we have a final question that we find it also very important, which is on value chain. So the aim of the methodology is to be applied across the value chain. But we know this can pose some challenges, especially in the measurement of the impact drivers rather than the outcome measurement and evaluation. But in any case, we want to know if you find that this is appropriate for your value chain analysis, if you have enough guidance, and if there is anything else you would like to see even beyond the methodology. So this is the methodology in a nutshell. I'm sorry we couldn't deep dive in some topics, so we welcome you in the public comments, and also if you have any question now that you would like to clarify, here we are. So Dan, back to you.
Thank you so much, Tamsin, Fran. So we have a few questions that have already been shared. We've got about 10 minutes before we wrap up this session. And so happy to begin with those questions that have been included, but please, if there are any other questions, go ahead and start submitting them. The first question that I will ask is from Malika. The question is, are remuneration impact and living wage deficit impact monetized, similar to what we see in the impact weighted accounts framework? If not, how do we speak to these impacts, and how does this translate into social and financial impact?
And so yes, both impacts are monetized with the well-being utility of income and the well-beings. As we mentioned, the value factors are publicly available for different countries. You don't have only the value factors, but also the inflection points, the living wage data sets, and different sources that could be of help in the analysis. So not only the impacts are monetized, but you can start doing it and testing the methodology.
Thank you, Fran. Anything you'd add, Tamsin?
Yes, thanks, Fran. I would point all members of the audience to the exposure draft. The appendix, Appendix B, has a spreadsheet with all of those numbers that Fran mentioned. And so the more people are playing around with those and putting this into action, and the more feedback you can provide us on after you've been experimenting with how the numbers crunch out for you, the better.
Thank you so much. I will move over to a question from Sebastian. Please, can you explain well-being utility of income and why they are multiplied again?
So let's start with well-being utility of income. We can say that well-being utility of income is a multiplier from wages to life satisfaction points. So that's like the implication itself. The definition can be found, the technical definition, how it's calculated. It's calculated based on the well-being gap and the income gap. But I think the main thing that is needed to say now is that it's like a multiplier that translates wages to well-being in terms of life satisfaction across the globe. And then the well-being is the other piece, translate life satisfaction to a monetized value. Each point of life satisfaction is a well-being per year per person. And that's exactly why we have these two, this double vision. We have a translation of wages to life satisfaction, and then a monetization of life satisfaction, so that we can, in the end, express well-being in monetary terms.
Thank you, Fran. Tamsin, anything you'd add to that?
No, I think that captured everything.
Great. One thing that I would note on these questions is there was a slide that Tamsin shared highlighting what are the data inputs and needs from the actual preparer of the impact accounts versus what is offered by the methodology itself. And so when looking at a lot of these underlying details about well-beings, et cetera, that is what is intended to be offered by the methodology itself. And it is company-specific data that is able to go into that to ultimately produce results about the actual impacts of the organization. And so that, I think, is actually a reasonable segue to another question from Malika around practitioner guidance. Will there be practitioner's guides with numerical examples forthcoming? And also, do you have a way to simulate the results that these new changes would create in comparison to the impact?
Thanks. I can start with an answer here and invite others from the team to jump in. So the methodology is sort of tightly scoped to provide the kind of intellectual justification for the methodology, the data requirements, the method for measurement and valuation, which is quite separate from, as you're pointing out, a practitioner's guide to what does this look like when rubber hits the road. We'd be very open to any suggestions throughout the comment period on what are those additional materials that would be helpful as a companion to this topic methodology. And also, based on your playing around with the numbers so far and what's in the exposure draft, and perhaps your simulation of the results that would change in comparison to the impact weighted accounts framework, what are suggestions you might have for those materials? I'll say another sort of input that we're considering is, of course, the VBA piloting that is ongoing with member companies, and taking any learnings from that into thinking about what are those future materials needed to be a companion to this methodology.
Thank you so much. I'm gonna try to squeeze in two more questions for us before we wrap up. The first, how do you set the diminution factor?
So it's obtained from the academic literature from a study by Jett et al. From 2018. And in that study, there are satiation levels discussed, income satiation thresholds by different regions. So in this case, we have to say that the first inflection point is this number by Jeff, but it's regional, so it's not adapted to each country, but to the region in which each country is. And that's the first inflection point. And the second inflection point is 4 times this first inflection point. It may look as a rule of thumb, but the main reason is that it was the moment in which the diminishing utility of income tends to plateau, tends to produce no additional well-being changes. So that was the reasoning behind the first and second inflection point. Nevertheless, I believe there are questions on that also in the public comment, and otherwise you are free also to give feedback if you have other alternative methods.
Wonderful, thank you. The last question I'll ask, this might be a challenging question to give a verbal response to, and that's because the question is, how would you visualize the wage deficit if you had to?
I'll go ahead and we can chime in. So no, you're absolutely right. The graph that's been presented is visualizing remuneration impact. And so what about visualizing the living wage deficit impact as well? I think an important point is that we do see those as 2 separate graphs, right? In line with the overall thinking in the methodology that those are 2 impacts. So on living wage deficit, if we were to sketch out a graph, I can imagine, if we use the same x-axis of wage or average wage, we're going to be into the negative region of the graph on the y-axis side, because this is a living wage deficit impact. It is an erosion of well-being, monetized well-being for the worker, and so it would also scale to the extent of deprivation below the living wage.
Great, thank you. Fran, if there's anything else that you'd add, go for it. Otherwise, okay. So as a way of closing, I'd like to thanks again to our speakers for presenting, and also thank you all for attending, particularly those who have stayed on the full 90 minutes. I think in any webinar, we will never be able to answer all possible questions or clarify everything for everyone in the audience, but hopefully this was illustrative of the work that we've been producing and the types of feedback that we're really keen on getting from you all. I think as a few summary reflections on my part, our goal in our development of these methodologies is to utilize the best available research and the best available work that's in the ecosystem, while simultaneously identifying where there are areas for innovation and expansion for this work to continue to be as valuable as possible for the world. And we're all doing that with the aim of producing this public good. And so this public comment period is so important to that, because if it to be a public good, it needs to have the input of the public. And so thank you very much for being willing to listen in and learn. And we would once again really encourage you all to review and provide any feedback that you have into the methodology itself. I've got the instructions up again around how we are inviting those comments. And for any further questions or conversations that you are interested in having that we have not been able to fully address in this conversation, please also feel free to reach out to that research at ifvi.org email address, and we will look forward to connecting with you. So with that, thank you, and have a great evening, have a great afternoon, and have a great morning.